The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. Bobby Rains here for our once every 3 weeks Investors Observer members only workshop. The same agenda we normally do. We've got a market update. We'll probably skip what's going on in Investors Observer this time through. There's not a whole lot to report. And then, as usual, the bulk of these conversations are member-driven. I'm happy to answer questions, site demonstrations, answer whatever sort of questions you may have. I have a couple questions I got ahead of time. And I'm always happy to put together slides for questions that are submitted ahead of time. Just mention, hey, this might be a good workshop topic. If it's something you'd like to see slides but also need an immediate answer for, don't hesitate to mention both of those things, and we'll try to do both of those things for you. All right, that's the wrong button. All right, let's see here. All right, so this is our pretty standard at this point, 2 years of one-day candles from the S&P. Yet these are the same sort of support and resistance lines we've been looking at for a while now. I tried to leave some of them out just so it's a little bit cleaner than the chart that's in the Friday afternoon weekend review piece. But these are kind of the big levels. And then obviously anything with a round number would also count. So 2,800 and 2,900, you could put a line through one of those also. But yeah, we've been sort of in a range for the last 18 months, and also, here more recently, we got the last 6 months here. We can see the range we've been in here. It's kind of bounded on the upper end by these highs, and then these lows on the lower end. This chart in particular is a good reason why I don't like the year-to-date market stats, and it's really just because the market bottomed here on Christmas Eve, and then we had this big rally. So the market is up for 2019, but zoom out a little bit and you can see we haven't really gone anywhere since the start of 2018. Like year-to-date, that January 1 date, it seems like the arbitrariest of arbitrary endpoints. All right, so this is a chart we've been doing the last few weeks because I think this is, maybe if you've been listening to the news outside of the trade stuff, this is a big one. Stocks versus bonds since 2019. I don't remember exactly where we were in terms of this when we did this 3 weeks ago. But stocks have pulled back from their widest point of divergence, but bonds have hit fresh lows. So we still have quite a bit of gap here, which is, you can see all of these things tend to come back together over time in terms of, that correlation. So I feel like something's got to give here at some point. I don't know what it's going to be. And while we're talking about bonds, the 10-year versus 2-year yield curve, it's a thing people talked about a lot. It's sort of flirted with inversion a couple weeks ago, and then again last week, and then Monday or so of this week, it went underwater again, and it's been that way since. 30s also went below the 13-week for a while. But yeah, the 10s versus 2s, you can see here a couple of things. One is that the recession isn't really immediate after. The shaded bars here are recessions. The recession isn't really immediately after the inversion. Sometimes things are uninverted before the recession starts, like we saw in the early 90s, or even in 2008. The inversions have been less deep over time, but also this isn't really a thing where it flirts with inversion and then everything gets better and we go back to solid growth. This period here is a little bit weird in terms of that. But the recession here was caused by a lot of things, including, yeah, it wasn't really a finance-driven recession in this same way as some other things. But yeah, it has done a pretty good job of predicting the last several recessions, so that's why people talk about it a lot. All right. On trade, yeah, still no one knows anything. September talks with China are, I think, happening. I didn't check in the last 15 minutes, but that's where we're at now with things, is that I think they're happening. And yeah, there were a bunch of reports today. I don't put a ton of faith in what you get from the Chinese media, but there were a bunch of reports in the U.S. media today quoting Chinese officials, which, again, don't really put a ton of faith in what the Chinese officials are saying. But U.S. credibility at some point does become an issue. There's questions about why. Yeah, I mean, there's questions about who made phone calls to whom at a certain point, which is sort of interesting. I don't think the Chinese appreciate necessarily Trump saying that they called and begged to restart talks. Whether they did or didn't, I don't actually know. But if they didn't, it certainly, doesn't, I don't think, strengthen the U.S. negotiating permission for that kind of thing to be out there. And then there are also things like the Iran deal, deals that may or may not have happened with North Korea, where it doesn't seem like either side is really holding up the parts of it. I mean, the U.S. just walked away from the Iran deal. And so that's also, right, like if you're China, do you want to do a deal with the U.S.? What do you actually get from that? Is it a deal in any real sense? Like it's great to agree to terms, but if nobody follows up, you haven't actually reached any sort of deal. So that it does become an issue at a certain point. So we'll kind of see where that goes. You'll notice the market is responding a little bit less to reports about progress with talks. So that's the other thing to kind of watch is the market not being manipulated by things as they go. Interest rates are still a thing. The Fed futures are still have about 2 cuts priced in before the end of the year. There are some people betting that it could be as many as 3, but 2 is where most of the money is at there. And the Fed is generally sort of reacting to the trade situation, which is weakening the economy. So that's sort of where that is. And then, some of the economic data is softening. The consumer data is still strong. I know some of the numbers that came out this week were a little bit soft, but some of those are, manufacturing numbers, and manufacturing is generally significantly less. It's just a less important part of the economy than it was some time ago. And so those numbers are sort of less important in terms of how well they do at measuring the strength of the economy. But yeah, the consumer remains strong. I know the consumer can be a lagging indicator. It has been in the past. So that's certainly something to keep an eye on. But what that really means is you won't know it's a top until the top is in, right? Like there was a thing the other day about consumer sentiment always peaks before a recession, but that's sort of no kidding, right? And you certainly can't use high consumer confidence to predict a recession. So yeah, there's not really a lot to be gained from that sort of thing. But the consumer is strong. Consumer spending drives a huge portion of our economy. So that's kind of where that is. And then, yeah, it seems like we actually do need to pay attention to Brexit again at some point. I guess Parliament is going to be suspended for a month starting in the middle of September. It seems like no deal Brexit is going to happen now. That's not good for the British economy and not good for Britain's major trading partners either. I don't have a good model for how it affects the U.S. in particular. So yeah, that's yeah, that's where Brexit is. It's yeah, it's certainly a negative, but how negative for particularly U.S. investors, I kind of have a hard time telling. Oh, all right, we got a couple of questions from David this time. The first one was, with ever-changing events causing so much volatility in the market, I'm staying pretty much on the sidelines. What concerns and suggestions might you have considering our portfolios and other subscribers? Generally, what we've been doing is sort of trying to pick our spots. That means trying to avoid things with a lot of trade exposure. That seems fairly obvious, right? Like your toy makers and some of the other things that have that are just importing a lot of things from China, we're trying to stay away from. We're trying to find trades we're comfortable to hold a little bit longer. That may seem a little bit counterintuitive, but if you're in something for only a week, and you get a big drop, your trade might go bad, and then you're only in it for a week. Whereas if it's something you can hold longer, the market has a better chance of being able to recover from the shocks you can't predict. So we're those are the sort of things we're looking for. But yeah, when you combine those two things together, it turns out there are fewer trades we're comfortable with, and so we've just had fewer positions. So that's sort of a function of where we are, and our general philosophy is we'd rather not put out bad trades. So we're doing that. We would like to have more positions, but there just aren't very many positions we feel comfortable with. We're looking for vertical spreads, not seeing a whole lot we like. Right now, we'd like to see some things there, but yeah, hopefully later this week or next week we can get something out there. But yeah, it's really about sort of trying to be cautious and pick our spots and find things that we're pretty comfortable with. All right. And then David also said he's been looking at vertical credit spreads, and he wanted to know about finding the break even. And also that I've said it's better to just get out when it looks unfavorable as opposed to some other strategies that people use to manage their portfolio, manage those vertical spreads. So the break even is really easy. It's the sold strike minus the credit, or on the bearish side, it's the sold strike plus the credit. And the reason that works is if you think about sort of the implied pieces of those option contracts. If the trade goes bad and you buy the stock at a strike price, at the strike price of your sold option, right? In the case of a put spread, you're buying it at the strike price of that sold put. Your true cost basis is that strike price less the credit you got for entering the trade. So that's why that works like that. And then, yeah, the getting out considerations. The thing that we always try to think about, even if you really want to, analyze your winners at the same time, is do you still like the stock? Most of the time, if the position is a winner, yes, I still like the stock. It's a pretty easy thing to come around to because the position is a winner. Well, once things start to go bad, do you still like the stock is a good question. If there's, some news or something else that's changed and you no longer like the stock, it's probably time to try to head for the exits. The other thing to consider is how much time is left. Right? If you don't like the stock, or if you don't like the stock, right, chances are you're not going to want to hold it until you change your mind, especially with a vertical spread, because that's got a ticking clock on it. But if you do like the stock, if there's 3 days left till expiration, that's probably a different way you're going to handle that than if it's 3 weeks, right? If you like the stock, you think whatever is causing it to go down is maybe overdone, you might have a better chance to sort of wait for a bounce or wait for it to recover or wait for the market to come to its senses, whatever. There's not a lot of time left, then you really got to think about sort of pulling the trigger a little bit sooner. And then the other things to consider are sort of, technical considerations. A lot of times we like to know where there's some support or resistance, and you can kind of draw a line in the sand there. Again, the time consideration comes in, right? If it's, a day where just everything goes down, and it hits your technical level, and there's a lot of time left. Maybe you say, all right, well, it didn't really break through it. It just kind of hit it and stayed near it. But if it, really crashes through a line you expected to be resistance, that's another reason to consider getting out. And then, yeah, market-wide considerations. If you still like the stock, you got plenty of time left, but you think the whole market is going south, there's no, depending on the individual situation, obviously you can invent a case where this wouldn't be a good idea. But if you just think the whole market is going to go south, then yeah, the bullish trade may not work. And at that point, yeah, you take what you can get for it and try to find something else. So that's what you do on that front. Yeah, and yeah, so that's the last pre-submitted question we have. Looks like there's a couple here. Let's see. David says the audio improved. Our air conditioner cycles on and off, and also I have a couple of microphones attached to my computer because we do some video conferences, and I switched to a better microphone because I noticed that the program didn't automatically select the one that I preferred. So that's probably what changed there. I'm glad it got better. Sorry if it was bad at the beginning. And then let's see, Daniel says he's been trading SLV a little bit more lately. SLV is the silver ETF. I think it's just a thing that holds physical silver, sort of like GLD on the gold side. We typically try to stay away from those. I have no real interest in being a commodities trader. And especially the precious metals, I don't. Yeah, I have sort of philosophical reasons to stay away from them, which are that a lot of people have very strong opinions about what the price of those things should be, and I don't. And I think a lot of times they trade unhooked from any sort of fundamental or technical sort of indicator, because people have very strong feelings about whether or not you should buy them and sell them in certain conditions, and so they become, there are commodities people who study those things and know how they work and do it all the time. But as somebody who's typically been more of a stocks guy, I don't feel like I have a good handle on how to expect those things to work, so I try to stay away. All right, are there more questions? Okay, well, there aren't a lot of questions coming in. I'll kind of try to filibuster a little bit while, see if people are typing. But yeah, we're, as always, going to put up the video and a link to the slides tomorrow, and we'll send an email out to people. Everyone can look at the, we have two sort of macro market pieces every week. One gets published typically Mondays around the close. That sort of tries to be a preview of the week ahead. And then we have a Friday after the close piece that tries to kind of wrap up the week that was. The Friday piece in particular has some more in-depth chart stuff periodically if you're interested in those, in the sort of technical, especially on the broader indices. If you're interested in those bits, we do that every week. And then you also get some sort of broad market commentary typically in those also. Also, there is, let me pop up the website here. You can email us at support@investorsobserver.com. Also, the website has this help button at the bottom of pretty much every page. You can hit that and send us an email also. So yeah, if you have any questions at any point, like I said before, if you want to get them in for the workshop, we can do that. Happy to put slides together, but if you have questions that are less, that are more timely or just something you're curious about, you can send us an email and we'll get back to that as well. All right, a couple more questions here. Dave says, it sounded like we had some development, but now it's quiet. Dave, you didn't miss anything. We just, we're still working on some stuff, but I don't have anything else to really announce about it. I assure you we will all let you know in probably some number of ways, including probably even an off-cycle workshop if that ends up being when the announcement comes out. We'll have all kinds of messaging that goes out when we are ready to do something. But for right now, I don't really have anything new to report. All right, so we have a question from Richard Brooks. Sorry, Richard. I don't usually use last names, but sometimes I read things out loud and say the whole thing. He says, a while back I sold all of my Boeing stock due to a decrease in value. A couple weeks later I tried to buy it back and was denied by the system. I contacted a counselor and was told that a member must wait 30 days before repurchasing the same stock. Please explain this requirement and the procedure that must be followed. So Richard, I think what you're running into is what's called the wash rule. And that basically, if you sell something at a loss, right, obviously you have a loss for tax purposes. And yeah, you're not allowed to sell something at a loss and then buy it back within the same 30 days. And that includes things like selling, right? So obviously it applies to single name stocks. That's not super hard, right? Like sell BA and buy BA is obviously, you can't buy the same thing. But you would probably run afoul of that if you had like an S&P 500 ETF and you sold it for a loss and then tried to buy a different S&P 500 ETF within that 30 days. That one may or may not be flagged by the system of wherever it is you're trading, but it could give you some problems down the road in terms of being a thing that is technically not in line with the rule. The language there is substantially identical. So two different ETFs that hold the same stocks at the same weighting would probably fall under the category of substantially identical. But that's my guess as to what happened. I don't know exactly. It says you were told to wait 30 days. So yeah, it's definitely seems like it's the wash rule that you ran into there. And that's to keep people from doing weird tax things, basically. If you sell something at a loss, you get a tax advantage, and then if you bought it back while it was still down, you could be trying to claim the loss for taxes and then also rebasing your stock, which they don't want you to do.
All right, I don't know if anybody else has any more questions, but if not, we can go ahead and wrap things up. If there are, go ahead and get them in there, and we'll try to get them answered. But yeah, like I said, don't hesitate to send us a note if you have any questions. We're also available by phone during East Coast business hours. And yeah, we are recording this, and we will send out that recording usually sometime tomorrow. And it'll get posted on the website as well. All right. Well, thank you all for coming, and I will talk to you in 3 weeks, if not before.